I'm going to provide an update on our current thinking around inflation in the US, and specifically why we think inflation is going to come down from current levels, but continue to remain high and persist above the Fed's desired 2% growth rate for at least the next several years. And we think something in the range of 2.5% to 3.5% is a reasonable assumption for where inflation settles by the end of the year. So, firstly, we think the current bout of inflation is really nothing like the 1970s stagflation era because we have none of the same drivers present today. Nixon depegged the US dollar from gold, which led to a significant depreciation in the US dollar. We had several oil embargoes with the Middle East that occurred over the decade and caused oil prices to more than quadruple. And the Fed had no credibility in terms of doing what was needed to bring down inflation at the time. None of those conditions currently exist. However, there were certain conditions that catalyzed very low inflation in the post-GFC period. And we also believe none of those conditions exist today. Banks and consumers were both deleveraging in the aftermath of the financial crisis, and credit growth was below trend as a result. This time around, bank and consumer balance sheets are very strong. So we expect both credit growth and a very tight labor market to drive higher inflation than last cycle. We believe all of these drivers will sustain an inflationary impulse above 2% for at least the next several years. The best assets to hedge against high inflation are commodities, and particularly commodities with strong direct links to consumer prices, such as energy commodities, certain industrial metals, and also some agriculture commodities. Other assets that tend to perform well during inflationary periods include deep cyclical equity sectors, such as banks, and upstream energy. Also, commodity exporters, most of which reside in the emerging markets ex-Asia.